95% of property investors lose money in their first 3 years. Not break even, actually lose money. And it's not because of market crashes or bad luck. It's because of 5 completely preventable mistakes that I see over and over again. These aren't small errors that cost you a few $100s. We are talking about mistakes that can drain $50,000, even $100K from your wealth building plan before you even realize what's happening. Hi, I'm Rajan Sharma, and over the past 10 years, I have helped hundreds of Aussie investors build successful property portfolios. But I've also seen the carnage these mistakes leave behind, including the ones I made myself early on that costed me dearly. Mistake number 1 is over-leveraging, borrowing too much money against your property. This happens when you go above 80% loan-to-value ratio, thinking maximum leverage equals maximum returns. Here is why this destroys wealth. When you borrow 90 to 95% of a property's value, you're walking a financial tightrope. Your mortgage repayments are massive, often exceeding rental income by hundreds of dollars per month. That means you're subsidizing your investment from day one. But it gets worse when interest rates rise, and they always do eventually. A 2% rate increase can add $400 to $600 to your monthly repayments. If you were already losing money, this pushes you deeper into the red. Here is the real danger. Even a small property price drop puts you in a negative equity. When you owe more than the property is worth, banks get nervous. They might call in loans or refuse refinancing when you need it the most. I have watched investors lose $40,000, $60,000, even $100K because they over-leveraged. They bought thinking they were being aggressive, but they were actually being reckless. The solution? Keep your LVR ratio at 70 to 75% maximum. Yes, you will need a bigger deposit, but you'll have breathing room when markets get choppy, and they always do. Build a cash buffer, covering at least 6 months of mortgage payments and expenses. This isn't optional, it's survival insurance. Mistake number 2 is what destroys more wealth than market crashes: buying without proper research. This happens when emotion overrides analysis and you fall in love with a property instead of the numbers. New investors get excited. They see a beautiful property, hear promising rental yields, and imagine their wealth growing. But they skip the boring stuff, the research that actually determines whether you will make or lose money. Here is what skipping due diligence costs you. You don't research local rental markets, so you overpay or expect unrealistic rent. You don't check recent sales data, so you don't know if you're buying at peak prices. You don't investigate upcoming developments that could flood the market with competing properties. When rental income comes in 20 to 30% below expectation, that's thousands per year in lost income. When similar properties start selling for significantly less than you paid, you're trapped in negative equity. When body corporate fees or rates are higher than anticipated, your cash flow projections crumble. The solution? Spend at least 4 to 6 weeks researching any property before buying. If you're not completely sick of looking at market data for that area, you haven't researched enough. Check actual rental rates, not advertised ones. Look at recent sales, not listing prices. Research upcoming developments, infrastructure changes, and economic factors affecting the area. Drive through at different times, morning, evening, weekends. Talk to the local agents about genuine rental demand, not marketing spin. Mistake 3 is the capital growth fantasy. Buying properties that lose money every month while hoping for future price increases. This approach can bankrupt you before you even see a profit. Many new investors think negative cash flow is fine as long as the property appreciates in value. They'll accept losing $200, $300, even $500 per month because they believe the property will double in value over 10 years. Here is the brutal reality. Capital growth is a hope, but expenses are a guarantee. That monthly loss hits your bank account like clockwork every single month for years. Over 5 years, even $250 monthly losses add up to $15,000 out of your pocket. But it gets worse. What if the property doesn't appreciate as expected? What if your circumstances change and you can't afford those monthly top-ups? What if you need to sell during a market downturn? While you're bleeding money monthly, you're also missing opportunities to buy cash flow positive properties that could actually build wealth instead of destroying it. The smart approach? Target properties that generate neutral or positive cash flow from day one. Mistake 4 is the buy and pray approach. Purchasing without any clear plan for when or how to exit the investment. This traps your capital and leaves you vulnerable to market timing and life changes. Life doesn't wait for perfect market conditions. Job changes, family circumstances, health issues can force you to reassess your property holdings quickly. Without a clear exit strategy, you become what's called a distressed seller. Always lose money. When you're forced to sell quickly, you accept the first reasonable offer instead of waiting for the best price. This can cost you $20,000, $30,000 or more compared to a planned strategic sale. Beyond immediate losses, being trapped in underperforming properties prevents you from capitalizing on better opportunities. Your money is stuck in assets that aren't working while better investments pass you by. There's also the stress factor. Properties without exit strategies become financial anchors, weighing you down mentally and limiting your options. This affects your overall investment confidence and decision making. The solution? Define your exit criteria before you buy. Set trigger points for selling. Maybe if rental yields drop below 4%, if major infrastructure changes threaten growth, or if better opportunities arise. Build flexibility into your financing and avoid loans with heavy exit penalties, and structure debt to maximize options when circumstances change. Review your strategy annually. Mistake 5 catches 90% of the investors off guard, massively underestimating the true cost and complexity of property management. This isn't just about collecting rent, it's about running a small business. Property management isn't passive income, it's active work involving tenant screening, maintenance coordination, legal compliance, rent collection, property inspections, and conflict resolutions. Each of these areas requires specific knowledge and significant time investment. New investors see property management fees of 6 to 8% and think they can save money by doing it themselves. But they don't factor in the hidden costs, your time, knowledge gaps, mistakes, and financial impact of poor decisions. Proper tenant screening takes hours of work, checking references, employment, rental history, and conducting interviews. Property maintenance requires building relationships with contractors, getting quotes, coordinating repairs, and ensuring quality work. You need to understand tenancy laws, eviction procedures, fair trading regulations, safety requirements, and tax implications. Getting any of these wrong can cost thousands in legal fees or lost rent. Property management means being on call. Emergency repairs don't wait for convenient times. Difficult tenants can consume enormous amounts of mental energy and time. Late rent payments affect your own financial planning. Poor property management leads to longer vacancy periods, high maintenance costs, legal problems, and reduced property values. The money you save on the management fee gets wiped out many times over by these issues. The smart solution? Factor professional property management into your investment calculations from day one. Let me recap these 5 wealth-destroying mistakes. Mistake 1. Over-leveraging. Keep your LVR at 70 to 75% maximum and build cash reserves. Mistake 2. Buying blind. Research extensively before making any purchase decisions. Mistake 3. Ignoring cash flow. Prioritize properties that pay for themselves. Mistake 4. No exit strategy. Plan your exit before you enter any investment. Mistake 5. Underestimating property management. Factor in professional help or proper education. These 5 mistakes are the difference between the success and failure. If this video helps you avoid even one of these costly errors, you have potentially saved more money than most people earn in months. Hit that like button and subscribe for more property investment reality checks. Drop a comment and tell me, which mistake do you think is the most dangerous? Or share which one you have seen friends or family make. Your experience could help other viewers. Remember, Property investment is a wealth building tool, not a get rich quick scheme. Respect the process, avoid these mistakes, and I'll see you in the next video.